The market is in a free fall, and you need to move your assets right now. You go to initiate the transfer, but it's reversed. Your funds are frozen. This is not a hypothetical scenario. It happened in 2008, in 2019, in 2020. When the financial system is under pressure, a single truth is revealed. The money in your bank is not entirely yours. It exists by permission, a permission that can be revoked. This is because banks do not fear volatility. They fear finality they cannot control. There is now a financial settlement layer no central authority can touch. A system where ownership is determined by verifiable mathematics, not corporate policy. This distinction determines who has control when it matters most. We are taught that money in a bank is safe. But the balance on your screen is not cash in a vault. It is an IOU, a bank's promise to make funds available on request. That promise is more fragile than it appears. In September 2019, the plumbing of the financial system seized. The repo market, where banks conduct overnight lending, froze. Banks stopped trusting one another. The Federal Reserve was forced to inject billions in emergency liquidity just to restart the system. The system's vulnerability lies in the gap between clearing and settlement. Clearing is the verification of a transaction. Settlement is the final, irreversible transfer of the asset. Clearing is a promise to pay, while settlement is the payment itself. In the traditional system, final settlement can take days, creating a window of risk. During this delay, transactions can be reversed. This power is a design feature. The same mechanism that reverses a mistaken payment can also freeze your assets. Your ownership is conditional, mediated by a chain of intermediaries. Your bank, a clearinghouse, the central bank. Each one is a potential point of failure or control. A financial system is defined not by how it performs on a calm day, but how it performs in a storm. 6 months after the 2019 repo crisis, the dash for cash of March 2020 began. As the pandemic triggered a global panic, the market for US Treasury bonds, normally the world's safest asset, evaporated. There were no buyers, only sellers. The Fed had to intervene as the buyer of last resort, overriding market function with a promise of unlimited support. But the system's stress fractures were appearing elsewhere too. That same spring, a gap opened between the price of gold futures and physical gold bars as the pandemic crippled delivery networks. To prevent a massive default on the COMEX exchange, the rules of physical delivery were simply changed. In each crisis, the story is the same. A central authority intervenes to override the rules. Final settlement becomes negotiable. The system protects itself, not the individual participant. In a crisis, what matters is who has the power to decide what is final. This history of crisis reveals the core compromise of traditional finance. To prevent collapse, someone must have the power to press undo. An alternative is a system where finality is guaranteed by cryptography, not by a committee. This is the fundamental innovation of a technology like Bitcoin. It is not just new money. It is a new settlement network that achieves finality without a central authority. When a Bitcoin transaction is broadcast, a global network of computers races to validate it in a block. Each new block is cryptographically chained to the last, creating a permanent, immutable record. As more blocks are added, reversing a transaction requires an amount of computational power so vast it becomes a practical impossibility. In this system, a transaction is final, not because policy dictates it, but because the laws of mathematics enforce it. There is no central administrator to appeal to, and no committee that can unilaterally change the rules. This lack of a central backstop is not a weakness. It is the source of its strength. It enforces non-negotiable finality, shifting settlement from human trust to cryptographic certainty. This technical distinction has profound consequences for what it means to own a digital asset. In the traditional system, ownership is an entry in a bank's private ledger. In this new model, ownership is defined by the possession of a cryptographic key. If you hold the key, you control the asset. Without that key, no one can move, freeze, or reverse your funds. This design dramatically reduces counterparty risk, the danger that the other party in a transaction will fail to meet its obligations. On a decentralized settlement layer, there is no central counterparty that can fail. The network is the settlement mechanism. This distinction is critical when evaluating products like spot Bitcoin ETFs. These funds offer convenient price exposure, but the investor is buying a security that tracks the asset's price, not holding the asset on its native settlement layer. Those ETF shares are cleared on the same traditional financial rails, with the same intermediary risks. An ETF provides exposure to the asset's price, but it does not grant its most profound property, self-sovereign ownership with irreversible finality. The result is a fundamental divergence. One system offers a ledger with an undo button, the other offers an unchangeable record. One relies on the flexible discretion of a committee, the other on the mathematical certainty of code. For more than a century, our financial system has been built on a foundational compromise: reversible transactions managed by trusted intermediaries. While this offers flexibility in normal times, in a crisis, those same intermediaries become the system's most critical points of failure. Today, a new paradigm is being built, a settlement layer based on code, not committees. It offers something radically different: irreversible finality. It presents a form of ownership defined not by an entry in a private database, but by the unyielding logic of cryptography. This represents an inevitable shift from a financial system based on trust me to one based on verify it for yourself. It is the difference between holding an IOU and holding the asset itself. This clarifies the fundamental question for the future of finance. When the next crisis arrives, the choice is not who you trust, but what you trust: a central authority's undo button or the certainty of the code itself.